In this course, we will present key terminology and documents associated with basic accounting.
Having a working knowledge of the vocabulary is necessary for reading and interpreting the balance sheet, the profit and loss statement, and the cash flow statement.
These 3 financial reports provide information on the financial health and operations, as well as the cash position of a company.
They are essential to business accounting because they provide details useful for evaluating a business's performance.
Since the first step is to learn the terminology, let's go. In this lesson, we focus on the accounting equation, which is central to double entry bookkeeping.
But first, it might be best to explain why it's called double entry bookkeeping.
Good point. This method basically says that for every debit, there must be a corresponding credit. When a financial transaction occurs, it is recorded in 2 different accounts, one as a debit and one as a credit.
Since each transaction is recorded twice, this method helps to reduce bookkeeping errors. Now to the accounting equation. It's a simple formula. Assets equals liabilities plus equity. This formula is foundational for the balance sheet and therefore is also called the balance sheet equation.
The balance sheet provides an accounting of a company's assets, liabilities, and equity, and shows the financial health of a company at a specific point in time. And the accounting equation is what ensures the balance sheet is correct because,
to be correct, an organization's asset must equal its liabilities plus its equity.
Let's define each of the parts of the accounting equation, starting with assets. An asset is something that provides economic value to an organization. It includes everything the business owns.
And something can be considered an asset even if it's not owned outright. For instance, a particular asset might still have an outstanding loan against it, but that doesn't change the fact that it is an asset of the organization. Specific examples of assets include cash and bank accounts, investments and account receivable, inventory, office supplies, buildings and equipment, patents, and goodwill.
When we look at our list of assets, most are straightforward, and it's easy to understand why they are assets. For example, cash, bank accounts, and investments are clearly assets.
Yes, and inventory, office supplies, buildings, and equipment clearly have financial value.
As do patents and goodwill. But let's take time to talk about one of the items on the list. Accounts receivable, which is money that is owed to a business. It lists customers who owe you money.
So why is it an asset? It's not cash at the moment, but since it's going to be cash at some point, it's counted as an asset.
Another thing to know about assets is that they can be described as fixed or current, tangible or intangible. Fixed assets are held for a long time, 12 months or more. Current assets are those that are generally used within 1 year. Tangible assets are physical, and intangible assets are non-physical. It's important to remember the distinction between fixed and current when you're looking at accounting reports.
Fixed assets are also tangible because they are physical. They are also referred to as hard assets. They are fixed because they are held for long-term use, to produce goods and services. They're not likely to be converted to cash within 1 year. These assets include property, plants, and equipment. Property, plants, and equipment are collectively called PP&E. PP&E assets are also referred to as plant assets.
Current assets are those that will be used or turned over in some form within 1 year. And while fixed assets are always tangible, current assets can be tangible or intangible.
Examples of current assets are cash, inventory, prepaid expenses, short-term investments, and, as you might guess, accounts receivable.
Think about it. Accounts receivable should be a current asset because, hopefully, your clients are paying you sooner than 1 year.
Well, one would hope so.
Let's consider inventory as a current asset. When you have items to sell, you don't want to keep them. You want people to buy them. And it would be good for business for these assets to sell fairly quickly. A business wouldn't want its inventory to just sit in a warehouse.
Therefore, they are current assets because inventory is there to sell, which is why you often see sales of items at the end of the year. Companies trying to sell inventory so that they don't have to keep it into the next year.
Prepaid expenses are items that are paid for in advance. They are recorded as assets because you own them until you use them up. Insurance is a good example. It's something for which you might pay for the entire year up front.
Now, someone might wonder, how is that considered an asset if it's an expense? It is considered an asset because you've paid for it before using it. Therefore, it becomes an asset of the company until it's time to expense it.
Short-term investments are also current assets. These include money market accounts that mature within a year.
So far, we've talked about the distinction between fixed versus current assets. Earlier, we mentioned there's also a distinction between tangible and intangible assets. Intangible assets are non-physical assets, which add value to an organization.
Examples of intangible assets are patents and goodwill, covenants not to compete, brand name, and even the purchase of client accounts from other businesses. All of these are non-physical assets that add value to a company.
And now that we've gone over assets, we're ready to take on liability. We're ready to discuss liability.
Okay, liability for accounting is exactly as it sounds. A liability is something that the organization owes to somebody else.
Like money owed to a vendor.
Yes, that liability would be in an accounts payable account. Your vendor sent you a bill, you owe that money to the vendor. Therefore, it's a liability. Expenses payable is also a liability account. It includes rent, salaries, and taxes.
Payable taxes include income, sales, and payroll taxes. These are all liabilities because
you're holding them to pay to somebody else.
Liabilities can be categorized as either short-term or long-term.
A short-term or current liability is something that's going to be paid in less than a year, within 12 months, such as a short-term loan and accounts payable.
And a long-term liability is something that's going to be paid over a longer period of time, beyond 12 months. An example of a long-term liability is a 5-year auto loan.
Or a building mortgage being paid over 30 years.
Bonds payable and credit lines are also liabilities.
Now that we've defined assets and liabilities, let's move to the last part of our equation, equity, specifically shareholders' or owners' equity. Equity includes stock and retained earnings.
To figure out equity, you add up the value of all assets.
Then add up all the liabilities, all of the monies that we owe to other people.
The difference between assets and liabilities is equity. But what's a good definition of equity?
Equity is the monetary value of a business after liabilities have been subtracted from the assets. It's also referred to as net worth.
Net worth can be either positive or negative, depending on whether the company has more assets or liabilities. When assets exceed liabilities, you have a positive net worth or a positive equity account. But when liabilities exceed assets, the result is negative equity or negative net worth.
Personally, I like the positive net worth better.
Me too.
At the beginning of this lesson, we introduced you to the accounting equation, which is also known as the balance sheet equation.
Why balance sheet equation? Well, the accounting equation is used to make sure the balance sheet is actually balanced.
And we've just defined some of the key terms necessary to read that balance sheet.
In our next lesson, we'll dive into the debits and credits of double entry accounting. Understanding how debits and credits are applied is vital to understanding both the balance sheet and the income statement.